Hi, everyone. Welcome to another Learn, Grow, Invest meeting. My name is Jermaine. I'm the founder, and we have another great meeting for you this evening. I apologize for the late start. Those who are used to our 6:30 p.m. start, very sorry. The stories that caused the delays are just incredible. Like, I wish I could share them, but it was just one thing after another. But I'm grateful to be here, grateful to be able to start this meeting. Thanks to my wife who helped me do some things so that I was able to be here, right? So, let's start. I'm going to pray and then we continue. So, Lord, we thank you for this day. Thank you for the chance to meet like this as investors, as persons who are seeking to build wealth. We pray for your wisdom. We pray for your insight. And as we go through this topic, may it be of benefit to those who view it. In your name we pray. Amen. All right. So again, guys, really, truly sorry for the delays. Let me know that you're here by leaving me a comment in the chat. Let me know who's here. If you've been waiting since 6:30, let me know. If this is your first time here, welcome. We're just gonna get started. Hey, Dane, how you doing? It's unbelievable. Is all I can say. The delay is unbelievable. All right, so I'm gonna share my screen and we're just gonna jump right into it. Yeah, thanks for that. It's gonna be a very good session that I am confident in, because we're gonna learn some good things today. Yes, Orville. So Orville, Orville let me know that he was waiting. All right, cool. So for those who missed it last week we spoke about how to find great stocks. And this is what everybody wants to know. And this is what I focus on as an investor. And I want to kind of share my process with you, share the process that, I believe will bring anyone to a point of making a good, educated stock pick, right? So I have to, say this is definitely not financial advice. The company that we're about to look at today using these examples, I'm not telling you to buy the company. That's completely up to you. Seek a licensed financial advisor before you make any investment decisions. All right, cool. So last week, we spoke about fundamental analysis. We kind of laid the foundation. We spoke about the fact that, we use financial statements, we use economic reports, we use forecasts, we use analyst reports, and we kind of use that information to make an educated guess as to which stock pick would be the best one to hold on to when we're trying to decide between multiple picks, right? So that's what we started to learn last week. If you missed it, I'll link the video in the description below to let you know, and so you can check that one out, all right? So for the first part of the series, we covered four main things. We spoke about, so fundamental analysis has two main areas. There's a quantitative analysis, there's a qualitative analysis. Now we're gonna wrap up the quantitative this week, and wrap up is kind of a loose term. We're gonna touch on some other things down the line, but next week we're gonna look at the qualitative side of things, which is gonna be a great session as well. So we looked at the three financial statements, and I want you guys to tell me in the chat what the three financial statements are that we looked at last week, and tell me the company that we looked at as well. So we did some quick analysis of these financial statements. We kind of looked at them, shared some things that you should focus on, how you should interpret it. We also spoke about the limitations of financial statements. There are some things that information just won't give you. And we went through an analyst report. And I don't know about you, but one of the things that kind of made me feel overwhelmed as a brand new investor was when I saw that report from a NCB, from a Barita, from a VM Wealth, and I'm not sure how to interpret it. So last week we went through that, and this week we're going to explain that section that I started to talk about last week, but I did not explain. I'm going to explain it this week, so you want to stick around for that. And so I'm not seeing anyone telling me the three financial statements in the chat. Is it that you don't know? So the quantitative side, which is what we spoke about last week, and we're going to do part 2 of it today. It's really about, quantifying the numbers, seeing any trends that may be there, doing some calculations or assessments with those numbers. And the main source of this information is the financial statements. So there are 3 statements. We looked at the balance sheet, we looked at the cash flow statement, and we looked at the income statement. All right, so those are the 3 we looked at last week. And here we have them. And we also looked at Wisynco last week. So we're going to continue the analysis with Wisynco this week, because we have even more insight to pull from the Q3 report. And we're also going to look at some valuation methods this week as well. So I don't know if anybody has seen the term PE or PB, price to book, and wondered what it means. I'm going to explain that tonight. And moderators, I'll ask you to share the link for these 2 statements in the chat so that persons can have it as well. All right, so in terms of what we're going to cover in today's session, as I said, part 2 of quantitative analysis, we're going to look at financial ratios. We're going to kind of look at 4 key types of ratios. And, 2 of them are from the balance sheet, 2 from the balance sheet and 2 from the income statement. We're going to look at stock valuation approaches. So there are 2 main types of approaches, and then there's one key thing within one type that we'll talk about, and that's the PE ratio. So we'll get to that, as I said. And then I'll share some resources. I'll share some of the links with you that I use to get information on the market, to do some comparisons. So I'll share those links with you in about 30 minutes time. All right, so financial ratios really provide us with insight as to the overall financial health or performance of a company. So even if you don't understand financial statements like an expert, you're not an analyst, you can use these ratios to give you a good idea as to how that company is performing. And it's this interesting thing where I learned ratios when I was doing my degree, and I always thought it was very, very insightful, the information it gave you. But at the time, I wasn't an investor, so I had no idea how to actually apply them. Now that I'm going through this to be able to share it with you, actually now it makes more sense to me than it did before. So the statements by themselves may not tell the whole story about the company. So we use ratios to be able to compare one company to the next. I would encourage you, though, when you do your comparisons, to focus on comparing companies of the same industry. Now, you may have a situation where there is only one type of company in that industry, so you don't have anything to compare it to. In that case, you either find the closest match, or you may actually look to see what the trends say internationally. So if you have one type of a company in Jamaica, you don't have anything to compare it to, you can maybe use a company in the US or in a Caribbean country, anything that is closest to it, so that you can use a fair comparison. So let me know in the comments below what type of company is unique in terms of its listing on the Jamaica Stock Exchange, meaning it's the only company of its type to list. Let me know any of those companies that you can think of. All right, so there are 4 key ratios that I mentioned that we look at. The first one is the liquidity ratio, and that speaks to the amount of cash. So if you say you're, person say I'm not liquid or I'm illiquid, it's really speaking to the amount of cash you have. And this is important because we saw in COVID where a lot of companies were able to continue to thrive because they had an abundance of cash. This is why you need cash for a black swan event like a COVID-19. So having cash as a company is extremely important. So we're going to see how to measure that liquidity of the company. Next, we're going to look at solvency. Now, when persons are preparing to lend money to a company, they look for certain things on their balance sheet to say whether or not this company has the ability to pay that debt. every single agency that does loans, they want to assess the ability of the company or the individual to repay that debt. And that's what the solvency ratios will show us. It'll show, that difference between debt and how much the company has, and whether or not it's in a good position in terms of how it manages debt. Next, we'll talk about profitability. Some say that this is probably the most important ratio to look at, because the focus of a company is profit. Now, there are some companies, some startups, and I'll ask you, there was an IPO that listed where the company maybe is not seeing the most, I can't phrase it in a certain way and not say, but can you think of any companies that might have listed, they're not profitable yet, but investors are bullish on it, and the stock price, I guess would have seen some improvement over the last few months to a year. So let me know which company matches that criteria. And then the last thing we look at is operating efficiency. Now, efficiency is really about how well the company can manage its costs. So in order to generate revenue, there will be a cost attached to it. There's hardly a way to generate revenue without an expense. Even the government in its collection of taxes would have an expense in order to get that revenue of taxes in. So the expense of the tax office, of the employees, of the things that the systems that would have been put in place to collect that revenue, that would be a cost. So this ratio is really examining how well the company is balancing the cost that goes into its generating revenue. And you want to watch this one carefully because it could signal a trend of maybe poor management, and you want to see how well they're kind of managing this cost over time. So all of these ratios that we look at, you want to give it a certain amount of time to do an assessment. Now, we are only going to cover two periods, and I want you to know that when you're using ratios, you want to go as far as you can. So maybe 3 years, 5 years is how far back you'd want to go in terms of comparing that ratio to see how it's trending over time. That will take some effort, but in 2 weeks from now, I'm going to show you how to create your own forecast and get all of the financials in one place and start to see those trends over time. All right. So first, we're going to look at liquidity. So as I said before, it's really how much cash you have. So this is one of the key measures that persons would look for. And there are two key ratios that come from liquidity. That's the current ratio, and that's the quick ratio, or the acid test ratio. And that's really just to kind of get a quick understanding of how liquid the company is without its inventory. Because depending on the company, inventory may or may not be easy to use, whereas on the balance sheet, inventory is typically seen as something that can be liquidated within the next 6 to 12 months. But depending on the company, it may not be that easy. So, I mean, the quick ratio kind of gives you a little bit, it gives you a different perspective than the current ratio would give you, though it's typically close, right? So these are the ratios that I was referring to just now. So if we think about the same balance sheet from Wisynco, we see current assets, we see current liabilities, we have those figures, and then we can just divide the assets by the liabilities, then we'll have the current ratio, and then we take that same asset figure, we subtract the inventory, then we divide that by the liabilities, and then we'll have the quick ratio. So I've plugged in the numbers from the balance sheet already, but we'll look at how to find the information. So I'm just going to bring that up so that you know how to find it. I don't just want to show you the numbers on the screen. I want you to know how you can find it as well. All right, so this is the report I would have looked at last week for Wisynco. This is their Q3 report. And if you want to find this report, I'd ask the mods to share it. But if they don't have the link, it should be on the Jamaica Stock Exchange's website, and I'll show you where to find it. So we're gonna go to the balance sheet. So we're looking for current assets. That would be right here. And let me actually zoom in so you can see it a little better. And then we want to find the current liabilities as well. So the current liabilities will be this figure. So once we divide one by the other, then we'd have the current ratio. So we see that right here. So we have the 12 billion divided by the 4 billion. So that would be 3.11. And that just pretty much means that your assets are 3 times your liabilities, meaning you could pay for them 3 times over. And so the data that we're looking at, so we're looking at the end of March 31st, and we're looking at the June 30th. I'm going to show you those again so you see where the data is coming from. So we took the audited June 30th, 2020. We have those figures for current assets right here. So we have 11 million. Then we had current liabilities here, 4.5 million. And then that's the data that we would have here. All right. So if you want to take the time and do the calculations yourself, you can. But as I said, for the purposes of the session, I just, plug them in for you. So since this was the figure, the 2.47 would have been what we had last June, and now it is 3.11. That's a good sign. So it's mean that it's headed in the right direction. Now we want to watch and see what the end of year for this year will be as well. But if it is 3.1 now and they end the year anywhere, let's say Q4 is similar to Q3 or better, then the assets might have gone up. The liabilities may go up slightly. So the ratio may still be above 3, which would be a 20% increase from where it was June 30th. So overall, we see that Wisynco is more liquid, right, than they were last year. So the next thing that we want to look at is a quick ratio. So as I said, it's the same figure, but we would have taken out inventory. And if we want to see the inventory figure, we go back to the balance sheet. We see inventory is right here. So this first column is March 30th. Let me just zoom in. This first column is March 31st, sorry, and this would be June 30th. So we go back here. We see those numbers, plug them in. Quick ratio pretty much signals the same thing. And so we know that they're headed in the right direction in terms of liquidity. The next thing that we want to look at is solvency. So this is about their ability to cover their debt. And I saw something interesting in terms of Wisynco and their management of debt. So we'll see that shortly. So let me just bring that back here. Yeah. So as I said, this is what creditors would look at if let's say Wisynco came to me to get a line of credit. I'll look at their balance sheet to say, well, do you have enough money to repay any line of credit or any services or any products that I may provide? That's what the solvency ratios would do. And so the main one that we're looking at on a solvency is the debt to equity ratio. And with these ratios, I want you to just focus on the name. It says debt to equity. It means that we'll be looking at their debt in relation to the equity. And we're going to go to the balance sheet for that. So we have total liabilities divided by total shareholders' equity. So we have total liabilities. So we have current and non-current liabilities. So we have 4 million here, 1.7 million here. And of course, these are in thousands. So when you go back to the PowerPoint, it would be in billion. And that's because, as I said last week, the balance sheet, the numbers are listed in thousands. Well, usually, depending on the size of the company. So all of these numbers that you're seeing in the millions, they're really billions of dollars that we're dealing with. All right, so we have total liabilities, that's current plus non-current. And then we have shareholders' equity, which would be 14 million, right? So we already can see that their debt compared to their equity, it's a drastic difference. So we have about 5 billion compared to 14 billion. So we already know that they don't really have a lot of debt, right? And that what that means is that their business is financed more with equity than debt. That's what that is saying to us. So let's look at what the numbers say here. So in the same order, this would be the numbers from the March 31st statement, and this would be from the audited June 30, 2020. So this would be what the numbers would say. So in terms of debt to equity, it's about 40% or 0.49 for the March 31st. And as at June 20th, it would have been almost half, right? So as I said, that's a good thing to look at. It means that the company is financed more with equity than with debt. And I mean, you could get into, like the types of debt. So you could look to see, sometimes companies would, get a certain type of loans or a bond or as I said, a line of credit. So typically the statement will show you the type of liabilities. So we see one here, for example, that says borrowings, and typically that would be explained somewhere to say maybe the type of loan, the interest rate, the tenure, things like that. So we can see in comparison to equity, it's nowhere close in terms of the debt to equity. And as we say, the assets are healthy so that if they were called on to clear their debts tomorrow, they could. All right. All right, so let's go back here. All right, so next we'll look at operating efficiency. Now, this is how well the management is able to manage costs, as I said before. So this is important because if the more you can manage costs or the better you can manage costs, then the more profit you will make. So operating efficiency is what we want to look at to see how they're managing costs. And if you remember that analyst report that we looked at, it would have alluded to cost saving measures that they would have implemented. So I'm going to bring that up quickly, where it would have mentioned in terms of them managing and putting in cost cutting measures. Let me see. I'm going to try and find it. Okay, so it mentions it here. There was a significant reduction in selling and distribution costs. So that would be one of the things we'll look at to say, well, yes, this company is good with managing costs. All right. So that's what the operating efficiency ratio would look at. So we're looking at operating profit over revenue, right? So we look at, let's go to the income statement. So we're looking at operating profit over revenue. That's what we're doing. And that will give us an idea of, because if you look at revenue here, the first thing that we're going to do is take out cost of goods sold. Then we have all the expenses related to the core operations here. So the selling and distribution, administration. And so if you just compare these two numbers here, it shows you how efficient the company is at managing the cost that relates to its generating of revenue. That's what we're looking at there. All right. So we're going to plug the numbers again. And so this is March 31st, the one at the top. And then we have June 30th, the audited financials here. And it's more or less the same. So this is 0.96. If you round up, that would be 0.1. And last year, the end of their financial year, was 0.1. So that's more or less the same. So this for their entire year, they were at 10% in terms of operating margin. And after 9 months, they're pretty much at 10%. So if you notice, though they may not have generated the same amount of revenue they're more or less the same in terms of efficiency. That's how you want to interpret that number. All right. And the last thing we're going to look at is profitability. Now, this, as some would say, it's the most important thing that you want to look at as an investor. You want to know that a company is making a profit, but it depends. If it's a startup, then the company may not make a profit, but it doesn't mean that the company wouldn't perform well on the stock market, right? So I'd ask you to think of an IPO that came out. The company really didn't make a lot of money, but it is maybe progressing in a good direction over the last 6 to 12 months. I haven't seen the company in the chat as yet. When I see it, I'll call it out. All right. So that's what our profitability ratio is looking at. So even if a company is able to, be liquid, be operationally efficient, be solvent, but they're not really profitable, then it's hard to imagine that they'll be able to survive in the long term. Now, we know a lot of popular companies that aren't making a profit that are still, around. They're able to pay employees, they're able to do good business, but they're not as profitable as maybe some other companies. So, take that depending on the stage that the company is at, the type of business they're in, because some industries, the margins are really low and so profits may be harder to come by, but the business may be at a certain stage where it's too big to fail. And one of the biggest brands that had this model for a while was actually Amazon. Amazon wasn't always profitable, but it kept on growing anyway. All right. And Twitter is another one of those companies I can think of as well that wasn't making a lot of money, but, still there. Well, if at all, I'm not even sure Twitter is profitable yet. They are? Akeem, which one are you answering? The question that I'm talking about for Amazon and Twitter? Let me know, because I might have it wrong. I'll check it and then confirm. So if I've said it wrong in the video, I'll confirm after and then post it in the description, because I don't want to mislead anyone. All right. All right. So in terms of profitability, we're looking at net profit margin. Now the formula is a little bit complicated, so I sought to simplify it by just saying let's focus on net income. But what we do is look at revenue, less cost of goods sold, less expenses, less interest, less taxes. So instead of doing all of that, we just look at net income, because that's pretty much what it is. I thought so. Yes. Well, yeah, Orville, I am keeping the scope local. It's just that everybody knows Amazon, everybody knows Twitter. So that's why I use those companies. But yeah, I get you. All right, so we're going to look at net income. And then we're going to look at, what was the next one? Net income and then revenue. So we already know the revenue figure from before. So we have the net income over the revenue multiplied by 100, and we get 8.85%. And as you see, this is March 31st, and this would be the June 30th. And they're more or less within, there may be about, this is what, a 0.5 difference between where they ended the year last year in terms of net profit and where they are now, which is an extremely good sign. So what this is telling you is that when the end of year financials come out for June, you're likely to see, actually, I think just from what we're seeing here, if we know, for example, places are going to be opened up soon, they should be doing more business locally. We saw last week where the bigger brand is doing well internationally. We saw where they've been able to keep their costs low. Even without doing any further analysis, I can see they're either going to do the same or better than they did last year. That's just an assumption based on what the numbers are showing me so far. All right. So we're going to talk about stock valuation now. And this one is important because we see all the time companies say that they have a target price a price that they think that stock is valued. And for a lot of persons, they don't know what goes into that. Does a number just come out of thin air? What is that process? So that's what we're going to talk about for the next few minutes. Stock valuation. Exactly, Orville. So they've been able to manage their costs very well. They have a whole heap of cash, and they have very little debt, and things are about to open up soon. So that kind of tells you that they're positioned to have either, well, the end of the year has already passed. It ended yesterday, but I'm guessing that either they were able to do, as I said, either match what they did last year in a pandemic, which would be very good, or do slightly better based on how we are seeing. So overseas would have been opened a little bit sooner because of, vaccine rollout. So like in UK, maybe the US and those countries, they have been able to go back to quote unquote normal. So if we say, let's say we saw in Q3 where there was 50% growth, I think for bigger in the UK, let's say that it continues on the same trajectory, then as I said, it's steadily on the rise, as you put it, right? So in terms of stock valuation, essentially what we're trying to do is determine the intrinsic value. And what that intrinsic value means is that we're saying based on the financial reports, news, some other data, we believe the stock price is valued X. Now, if the intrinsic value is higher than the current price, the market price, then that stock is considered to be undervalued. Those are the stocks you want to buy. If the intrinsic value is less than the current market price, it is said to be overvalued. And theoretically, those are the stocks that you want to sell. Now, everything is in context, of course, because the intrinsic value doesn't always, so as you see here, it's an art and a science. So it's not exact. There are multiple ways to get to a valuation. There are some best practices, and there are aspects when we get into the qualitative part that you'll see where it's not just about what are you saying, Akeem? Can you repeat that? What are you talking about? Wish I had placed what on a slip. Yeah, so definitely market sentiment as well, Orville. So that is actually one of the things that that's one of the things that really drives the stock price. And we're actually going to speak about that when we talk about the qualitative side of things next week. All right. So, okay. So there are two types of stock valuation. Well, two main categories. So we have the absolute and we have the relative. And if you know those terms from high school or maybe university, absolute is when you do a calculation, you get a value, and oh yeah, so no problem. Okay, so the absolute would include two methods like dividend discount model and discount cash flow. That's actually one of the popular methods in Jamaica, the DCF. And then you have relative, where you compare that company to similar companies. So I'm going to show you soon a report from VM Wealth that compares Wysinco with other manufacturing companies. We're going to look at their PE. We're going to look at their price to book. We're going to look at their EPS and see how they stack up against those other companies. All right. So in terms of the dividend discount model, this now what it does, it assumes that the dividend is going to represent cash flow to its shareholders, and the intrinsic value is then now the present value of future dividends. All right, so this would only apply for companies that pay dividends consistently. As I said, when I did my research into this, I couldn't find an entity locally that does it. It doesn't mean that none of them do, I know companies in the States would do it, but the one that we're going to talk about next, DCF, is the one that I know of that is used more often. So essentially what you're doing is you're calculating future dividends or the value of that, and then you're putting present value on it because of course we know time value of money. So if you're talking about future cash flows, then you have to put it to now based on a present value, and that kind of gives you an intrinsic value for the company. I'm trying to explain it in very simple terms. Hopefully I didn't lose anybody there. And then the next one, we have discounted cash flow. So this is calculated by discounting the free cash flow. So there would be a discount rate that's applied, and then you calculate the cash flows, and then you do a present value based on that calculation again. I know there was a Stocks on the Rocks episode where Simon did, I think he used the DCF model on Creamy, if I'm not mistaken. So Simon, if you're here, confirm that for me, or anybody from the Stocks on the Rocks team. But we had a meeting with them, I think in March of this year or February of this year, and Simon used the discounted cash flow model for calculating what Creamy's future cash flows might look like based on a particular discount rate, right? So that's what that process is. As I said, I'm going to teach you that step by step in about 2 or 3 weeks. So don't worry about it right now if it's the first time you're hearing the term. All right. And then the last one, which is the relative valuation method, is it uses what's called a price multiple of similar companies. So the PE ratio, or price to earnings ratio, is called a multiple. So if any of you follow or track US investors or podcasts or anything like that, when I speak about a multiple, this is what they're referring to. There is usually a measurement or something that they use to compare companies. So PE is a multiple, PB is a multiple, and we say enterprise value to EBITDA is a multiple as well. All right, so we're going to talk about price to earnings now. So price to earnings is one of those ratios that, depending on who you talk to, persons are either tired of hearing it, or persons will swear by it, or you might have people in the middle. But I use it as one of the measurements, not the only. So for example, it says here that it is used to determine the attractiveness. And so when we look at the PE later, you'll see, especially locally, where you have companies that have, I think, a PE lower than 20 or 21 is considered low, depending on the industry. But for some companies, they may have PEs of 30 or 40 or even 50, and their price may still be doing well based on maybe some other factors. So it's not, the PE is not the only thing to be used. A lot of places, though, they would put a high emphasis on PE, and it can be a little misleading. But just understand that when you use it, though, you're looking for the best way to use it, I think, is to compare it with other companies in the same industry. That's what we're going to do. I'm going to show you how it's calculated first, though. So think about the ratio again. It says price to earnings. So we're going to compare the market price or the stock price to the earnings of the company. All right, that's essentially what we're doing. So we're going to take the price to the price is divided by the earnings per share. So if I just do a quick look at Wisynco statement again, at the bottom of it, we actually see the EPS shown there. So this number that we're seeing here can be calculated, and we would be seeing as well. So this is a net profit. We know that already. The 672 million, that's the net profit. The shares outstanding, we can get that information on Jamaica Stock Exchange's website. So I'm going to bring up that page right now. So I'm on the Jamaica Stock Exchange website. I'm going to share the link in the chat. I'm going to put it in the description as well. So this is, so for market data for Wisynco, let me actually refresh the page so that it's current. So if we scroll all the way down to the bottom, we'll see some information about Wisynco. Let me zoom in. So it last traded at $15.80. For today, it traded between $15.80 and $16. For the last year, it traded as high as $19.50. The most important thing that we're looking at shares outstanding. So this is the number of shares in circulation, you would say. And this is a number that we use to calculate earnings per share. So we take the net profit, we take the shares outstanding, and that calculation gives us an EPS of 18. And as I said, if we go to the income statement, we see that 18. So I want you guys to understand that if you know what the information is and where to look for it, you can save yourself some of these calculations. You won't have to always do it now. If you want to do forecasting, then you will need to input those numbers yourself, because I can't think of somewhere that would provide that information at no cost. But if you want just a quick reference point, I'll show you, there's a Mayberry trade sheet. Let me bring that up as well. So the Mayberry trade sheet is something that I use often as well. So this will be, I don't know how often it's updated, but this should be as at today's date. So let's see the PE for Wisynco as at today. It would be 22.3. Let me zoom into this. All right, so I'm going to post the link for this as well. All right, so let me go back to the PowerPoint. So that's essentially how we calculate the EPS. Now, once we have the EPS, we take the current market price, and that's how we would calculate the price to earnings ratio. All right. So I'll show you the source of this information next, but I took this from the VM Wealth weekly stock picks PDF, and I just use all the manufacturing companies that it showed. There's one that's left off. I don't remember the name right now, but what this is showing is the EPS for companies in the manufacturing sector. And so what this is saying is that earnings per share, so for every share that is out for the company, you're earning 71 cents in terms of Wisynco for that share. For separate, you're earning $3.80 for every share that's out. For Carib Cement, you're earning almost $5 for every share that is outstanding. That's how you interpret this number in terms of earnings per share. And as I said, think about the name. The name tells you what it's doing. And then PE, as we say, well, I didn't do the calculation myself. This is what it shows on VM Wealth site, that the PE for Berger is 55. All right, so just wrap your mind around that. But Wisynco we saw was 21 at the date that the sheet had come out. It's since higher according to Mayberry. And then we have Seprod, we have Carib Cement. So we see if we take these three companies, they're close. If you wanted to find the one with the lowest quote unquote PE, that would be Seprod as at the date that VM would have released this, right? And that brings me to another point. Usually the data that we have to make decisions is historical data. So if you don't get the data in a timely way, you may not be making the most accurate decision. So if you're looking at data from 2 months ago, 3 months ago, and that's why the forecasting would be important. You want to get an idea as to where the company is headed, because if you use outdated information, you may make the wrong decision. All right. And the next thing we're going to look at is price to book. This is another multiple that's used. And this is used to determine whether or not a stock is valued correctly. And if you think about it again, price to book value. So the book value is essentially the equity. And we're going to look how that is calculated in a second. So low PB means it's undervalued, means it would be considered a good buy. High PB would be considered overvalued, but again, in context, you want to think about that in relation to other companies. You want to look at some other information and not just use price to book. All right. So we take the market price. That's where the price would come from, and then the book value per share. So we take the shareholders' equity and the outstanding shares. So let's go back to the income statement. Shareholders' equity would be balance sheet, this number here. And then we know the shares outstanding from JAM StockX, which would have been 3.75 billion. We would use those in the ratio, and that would give us the price to book. I don't think I was able to do this calculation in time for today, but that's how you would calculate it. But we're going to see that information in the report that we're going to look at as well. All right, so I would have shared these links already. So let me bring up the same report that we looked at last week. All right, and then we're going to take everything that we just learned in context. All right, so hopefully everybody's following me so far. Hopefully I haven't lost anyone. Let me know if you have any questions. So we're going to explain this entire section here now because of what we just learned, right? So I'm going to zoom in here. So this was the price as at June 16th. Let me actually remove myself. There we go. So this was the price as at June 16th. It was 15.41. The financial year ends June. So as I said, we have ended the financial year for Wisynco. So this report for their end of year, I think, would be due either mid-August, maybe close to the end of August. You may see it. Latest would be end of September. 52-week range, we already have that information. The trailing EPS, so the trailing earnings per share, and this just means for the last 12 months, would be 0.72. And we saw this number somewhere else already. The book value per share, remember the equity divided by the shares outstanding would give us the book value per share. And we looked at, the current trailing PE would be, again, the number that we're looking at for the last 12 months. But as we see, since even this was released, it's now saying on Mayberry that it's 22.3. So the PE has actually gone up. And current, price to book is 3.88. The price target, though, so we would have looked at this last week, but we didn't quite understand how to interpret it. What NCB is saying, based on the data they have as at this date, their target price or their calculation for the intrinsic value of Wisynco is 16.30. And I believe they would have mentioned in this that they used the discount cash flow model. Again, I would go through it to ensure that I'm not saying anything incorrect. But what they're saying is their target price based on their calculation for Wisynco is 16.30, which is why they're telling you to hold, right? So if you look at the difference between if you buy one share for $15.41 plus fees, your average cost would be about $16.10 or $16, depending on how many units you buy. So if you sell at $16.30, less fees, you would essentially lose money. So usually when the target price is close to the current price, they'll tell you to hold a stock and not buy it or sell it because they want to wait a little bit longer to see how it will perform. So I'm thinking, though, that you want to watch this. I would watch it closer. So if you're holding Wisynco, my advice to you would be to keep tracking this information, keep tracking what the PE looks like, keep looking at any news or anything coming relating to how well they're doing. And usually there's an indication. So usually a few days before the report is due, you may start to see some movement on the stock price. Typically, it means that either investors are anticipating positive results or negative results. If persons are anticipating positive results, you may see some movement in the stock before. So a mistake a lot of investors make is that they try to buy a stock after it has started a run. That's not the best time to buy a stock. You want to buy and do your analysis early. So I like to say that I buy stocks when nobody's talking about them, because that's typically when you get the best price. So when nothing is happening in the news, when nobody's talking about it, when maybe the Q3 report has come out, you may want to look at certain things, do your forecasting, your analysis, and see if you think that a company is bound to end the year well, and you can make a decision to purchase from that point, so that when the results come out, if you're right, then you'd have got in early. If you're wrong, you may want to hold it for a little bit longer or take a loss, right? That's kind of how I would recommend it. But let's say that Wisynco does better than expected. This target price would change. But what you'd probably see is that the price starts to move, the price goes up, and then they publish this after the price has run up. Hey, our target price is now something else. And at that point, it's too late for you to buy. So that's kind of how there's this kind of cycle of reporting that takes place. The information usually lags behind the performance. It's very rarely that you will see a company say that this stock is projected to do well before it does well. It's typically usually after the run has started, because we saw that, for example, one year with Barita, where it just did this incredible run. And, people were like, okay, can't get any higher. It went from, I think, $19 one year to almost, 50, 60, or even more. So, I mean, just bear in mind that you want to buy at the right time, depending on your time horizon and goal for the company. Or if you want to buy a solid company and hold it long term, the price doesn't matter. Price would really come into play if you're buying for the short term. If you want to buy for 3 months or 6 months, or maybe sometimes a year, you want to pay attention to the price, because that's a short time frame. And I put short in quotes because it can be long for some. So if you're buying long term, if you're buying this for your children, or you're buying for 5-10 years from now, if you pay $15 or $16 or $18, it's not a big deal if you're holding it 5-10 years. Now, if you're holding it 5 weeks, then it may be a big deal. All right. So hopefully that would have made sense to you. Let me bring up the VMIL link as well. So let me stop sharing for a second there. All right, so I can actually take some questions while I'm bringing up the VMIL report. I think I have it. Yes, I found it. Great. And I'll get to those questions very soon. I'm seeing them. Just give me a few moments. So the range in terms of PB, we will look at that very soon, Sashana, and the link from NCB. So you have to be an NCB customer. It actually was sent to my email. So it's not on their website. I searched for it yesterday, couldn't find it. Yeah. All right, so let me share my screen. So this is the VM Wealth report. We always want to watch the date of the report. So this is June 14th. So this is 2 weeks old. So this is 2 weeks old data. So just bear that in mind, but we're going to focus on the example. All right. So what this does, and they release this every week. Let me actually find the website to show it to you. Let me search for it. I'm a VM Wealth customer. Well, clearly I'm a VM Wealth customer. I'm an NCB customer. I'm a customer of a couple brokerages for the benefit of the reports. So that's one of the things I do. I want to sign up for every broker, get a copy of their report, see what everybody is saying, and then I'll make a decision as to whether or not, based on what they're saying and what the information that I find, whether or not it matches, right? So I want to see what the experts have to say, and then I can pretty much determine whether or not I believe them. That's pretty much how I do it. All right, so I'm going to share the screen again. So this is the link. I'm going to post that in the chat. That's where the VM Wealth stock reports come from. So you can bookmark this, check once per week, and you'll see it. So that brings me to this. All right. So what it's showing here, I'm not going to spend a lot of time here, but what I'm going to do is show you a few things. It shows a stock. It'll tell you the closing price. Let me zoom in. It will tell you the closing price, the year-to-date change, the PE ratio, the PB, and then it will show you like a 4-week price movement for the company, and then it'll share their recommendation and rationale, right? So they'll say, they'll have a 5% increase in operating income. We now know what that is. So everybody here would have learned what that is. So it went up from 8.8 to 9.3 for the quarter ending April. It tells you what the increase was driven by. So as we said last week, usually when they state a number, they tell you what is behind that number. So it went up because of, improvement in net gains on foreign currency activities, net fee and commission and insurance revenue. It exceeded all capital requirements and remains well capitalized. So you want to focus on the point of this sentence. They remain well capitalized. We remain cautiously optimistic that they will continue to improve on financial performance in the near term. And so what I'm thinking when I read this is a very measured recommendation. We remain cautiously optimistic. It means that they're not telling you to buy, they're not telling you to sell. It's like, we're gonna wait and see. And the recommendation here is market weight. And if we go to the very end of the document, we'll see what those terms mean. So market weight, it means that the security is expected to provide fairly similar returns compared to the market in the general, or at the same time, or the same pace as comparable companies, neither strongly positive nor negative. And that's why they were so measured in their outlook of it, because what they're saying is that they are not expecting any major upward or downward movement for that particular one. So what you can do, and this is not a shortcut but a tip, right? If you want to really know what the analysts think, you want to look at what is showing undervalued. So something that says overweight, undervalued, underweight, overvalued. All right. And then you go back to the very top, and then you can say, all right, which companies are they saying that they would recommend that you buy? All right. Overweight means undervalued. Anybody know a company called GK? That's one of them. Seprod, that's one of them. JP, that's one of them. All of these companies, they're saying they're overweight, meaning they view them as undervalued. That means they're expecting growth in the short to medium term, right? and then you can read the rationale, see what the closing price is, get a quick okay, let me repeat that for Akeem. So what I'm saying is, if you want to interpret the report, you want to look at what the analyst is saying about the companies, right? So in this report, we have 1, 2, 3, 4, 5, 6, 7, 8 companies that they are recommending. Typically, they would show a mixture of market weight, overweight, underweight. If you want to know which companies they're interested in or they think will move. So if, for example, if you had a VM Wealth advisor, they would probably have gotten this information from their research department, and this is what their research department thinks the performance of these companies will be over the short term. That's how you would interpret this information. And what I'm saying is, if you go to the very last page, so remember we learned that intrinsic value, we're looking for stocks that are undervalued. So if the term overweight is used, they think that the stock is undervalued. So that's what I was saying, Akeem, where if you see the phrase overweight, then what they are saying is that they think at this point of the year that Mailpac is undervalued. They think at this point of the year, Jamaica producers is undervalued. That's what they think. And they would have given you their rationale why. So let's look at JP. For example, it is saying that we believe that JP has enough liquidity and is well capitalized to take advantage of this opportunity and similar projects of this nature. So it would have given you a sort of overview. Now, this is a very, very short synopsis of the company, which is why I kind of like the NCB report a little bit better in this regard. It gives you a lot more information. So NCB gave you 7 pages on one company. So now they don't publish this often. So I always ask, okay, if you're only putting all your energy into one company, then why? You know what I mean? Is it that you have a preference for this company? Is it that you think it's the best company to present on? Is it something arbitrary? Those are the questions I'm asking myself, right? So I take the information for what it is. I read it, but I know that this gives me a lot more information in terms of the body of the analysis versus one paragraph, right? So that's kind of what I'm saying here. I brought up this document though to show you this part. Let me zoom out. So what VMIL does, which I really like, is that they look at, they'll give you a sort of kind of quick comparison for all of the companies on the exchange. So we're looking for that word overweight again. So we see it here. So this is what VMIL is looking at. So these are the stocks that they think will perform well over the next, as I said, whatever period this report comes out. So since it comes out weekly, it could just mean for this week, these are the ones that they're bullish on. It may change next week. You don't know. All right. So we're focused on manufacturing though. And well, before I go there, I really like the fact that they segment the companies here. So if what I used to do is look at all the companies under finance, for example, I would zoom in and say, okay, this is how Barita is doing compared to JMB, compared to Mayberry, etc. All right. And then it would tell you the most recent report, which is very important because time of year is important. And so I'm going to scroll down to manufacturing. So the sheet that I showed you, let me go back to it. This one, this table here would have come from this section. So they have all the manufacturing companies. They have a sector average here. You see that in the lower part right here. And let us see what we're looking at. So these columns, you need to understand what they are. So we're looking at the ticker symbol, most recent report, quarter end, 52-week range in terms of stock price. We're looking at market cap. Let me actually go full screen again, easier to see. Last sale price, 1 day movement. I don't really see how this is relevant, honestly. The price change weekly. Okay, year to date. This may be an interesting one to look at. Then we have earnings per share. Again, we know what that means now. We're looking at PE. We know what that is now. Book value per share, and then price to book. So all of these numbers now, if you're just joining us, if you rewatch this video, you'll understand what all of these numbers mean. We would have explained them earlier. This is return on equity. We haven't looked at that yet really, but we'll do it at a later date. Dividends, expected dividend deal. We're gonna have a video completely dedicated to dividends, so I'll get into that another time. But I like to look at the dividends as well. I'll share my dividend strategy soon as well. Then we look at the recommendation, and we know what the recommendations mean now from the table below. So I'm gonna go back to manufacturing, and this is what I'm looking at, right? So this fourth line is with Cinco. And again, this is information we know. 13 to 19, the price movement for the last year. I believe this figure is what? So this is market cap. Then the next one would be closing price, day change, I think weekly change, year to date change. So we Cinco is down 8% year to date. EPS, I know, so we've seen this number 4 or 5 times. We know what it means already. This is the EPS. This is the PE ratio, and we're seeing now, so this is where it comes into play. The sector average is 17, and it is 21, so it's slightly above the sector average. And this would be the price to book and the price to book ratio, and the average for the industry is that. So that's how you want to use these numbers. You want to look to see how it compares to the industry. But as I said, you can't just look at it and say it's higher than the industry average, it's high. That wouldn't make sense, because you could possibly ignore a company that has more room for growth than another company with a lower PE, right? So let's look at this one that has the low PE. I think this is Salada. Yep. So Salada might be an interesting company to look at one of these days, so we may do that. Then we have Seprod as well. That's the fourth one that has a PE of 18.6. And so that's how we can interpret the information that's on the sheet. And then this would be the year-to-date performance, I believe. No, return on equity. Okay, I don't want to get into that today. And this would be dividend. Yes, so who paid a 50 cent dividend? Let me see, that's probably Seprod. Yep. All right, so so this is what you can do in terms of the companies that you're holding. You can look at how their PEs would compare to the industry, the price to book, you know, how that relates to the other companies within the industry, things like that. And yeah, that's kind of it for today. I'll take any questions that you have now. Really was trying to keep the session 1 hour or less. We're at about 70 minutes. So I want to just take questions and wrap up. But hopefully this session was good for you guys. Hopefully you learned something. Let me know in the comments below if there's any question that you have. If I missed your question, just post it again in the comments below the video, and I'll get to it very soon. We answer all comments on this channel, so you don't have to worry about that. So yeah, hopefully this was helpful. I'll speak about what we're gonna cover next week. So all these links I've already shared in the chat, so you have them already. And that's the end of part 2. So next week, we're going to look at part 3. We're going to look at the qualitative analysis. So we're going to look at things like market share. We're going to look at sentiment. You know, somebody mentioned that earlier. We're going to look at all the things that doesn't have a dollar value, but it's important in your analysis of the company. We're going to do some market research. So David Rose joined us about a month ago, showed us how to do research. We're going to take that to an even further step. And we're going to connect some dots, right? So we're going to look at some information from the news, what we know of the company, what we know of the forecasting, and say, okay, what do we think this information we have, how it impacts the stock price? And then I'm going to share again some resources that can help you. And that is it. Yeah, so I mean, it's going to take you a while to get used to this information, especially if it's your first time. But the reason why I keep the sessions so simple, I want persons to see that sometimes the reports themselves, well, this is my opinion. You may not agree. I think a lot of times it's more a marketing document than an analyst document. So sometimes you want to kind of filter through to the meaningful information first and kind of disregard everything else. So that's what I kind of train myself to do. So I have some set pieces of information I want to get. I go straight to it. All right, so in terms of PB ratio, you want to look at the sector average. So let us bring that up again for you to see, because you want to, so price to book ratio doing, let me share my screen again. So this is, remember this column was PB, right? So PB ratio right here. So the average for the sector is 3.2. Notice when we go to another sector, it's a different average. It's a different average here. So you don't want to just say a good PB ratio is 1, and then you see 3.8 for Wisynco, and you say that's too high. You want to compare it with the industry, because we have one company here that's 6.15. If you turn away from that company just because of PB, you may miss an opportunity. So that's why I'm not even showing the companies here, because a lot of times when you get recommendations, they're doing it solely based on PE, solely based on PB, and it does not give you the full picture of the company. There are other things that you want to include, not just the PB ratio. So you want to look at the average for the industry doing, and not just the number itself. All right. All right, hopefully that was clear. Let me see if we have any questions here. The sheet would be an easier way to find factors for margin of, so Akeem, in terms of margin of safety, Chike is actually going to have a session in our Facebook group this weekend to go over margin of safety. Is that right? I'll confirm with him, but I think so. Chike, if you're here, please confirm. If not, then at some point, I'm sure we will cover margin of safety. So that should help to answer that question. But in short, this is how I'll explain margin of safety for those who've never heard the term before. You take the intrinsic value, and then you take the market price. The difference between the intrinsic value and the market price is considered your margin of safety. So I'm going to give you a very simple example. If the market price is $10, the intrinsic value is $20, you have a 50% margin of safety, because from the intrinsic value price of $20, the stock is currently $10, it's 50% in terms of difference between it and the target price. So your margin of safety is 50%. All right. So that's how you'd look at the margin of safety. It's very, very simple to get an understanding of it. So Sashana is asking, are you saying that the sector average is the basis for the PB? No, so the sector average, what they're doing with that number, let me share the screen again. It's taking the average. So if you guys remember in high school when they did mean, median, those numbers, you look at the average for the industry, meaning all of these numbers, then average would give you this. And what I'm saying is when you use and think about a number like a ratio, you want to compare it. You want to compare apples to apples. So you wouldn't compare the price to book for Wisynco with NCB. That wouldn't be a good comparison because they're completely different industries. So I'm saying that the sector average, which is this number, can help you understand how much higher or lower than the average that company is. So hopefully that helps. Sashana, let me know. Akeem is asking if I think the sector do you think sector would be a good benchmark to compare against? I mean, you want to compare within the sector. You want to compare manufacturing companies with manufacturing companies. It wouldn't make sense, as I said, to compare Wisynco with NCB. Now, if it is you're trying to determine, do I invest in NCB or do I invest in Wisynco? The ratios, if you compare them, so PE ratio versus PB ratio for the companies may look different. Okay, great. Because so let me look at that information so we can see it. So NCB is this, all right? So the PE ratio for NCB is 23.3. We know that for Wisynco it's 22. So the PE ratios are close, but they're different industries, different growth rate, different challenges, different effects in terms of how their propensity to generate revenue would be. So if you compare the two of them, I don't think that's a logical comparison. Now, I would have asked you guys before to think of companies that would be either in industries by themselves. So for example, with the insurance industry, we only have two companies. So, I mean, you really have only two companies to compare. One has a PE of 48. The other one has a PE of 8. One is Key Insurance, one is Guardian Holdings. So many person would say to you, just from this information, Guardian Holdings is undervalued, Key Insurance is overvalued. Does that mean you buy one versus the other? As I said, it is a part of the story. It's not all of the story. So after we look at some of the qualitative things about it, then we can have a better understanding. Exactly, Orville. So NCB is financial, so you compare it with Sagicor, with Scotia, with GMMB. That's how you would compare it. So if you want to make a decision on NCB, you want to look at some of the other companies within that same industry, and that's how you can do it. So for example, Carreras is the only one in retail. There's nothing to compare it to. Conglomerates, we have Panjam, which is in real estate, Grace Kennedy, which is in retail and services. It's not even logical, I think, to compare the two. So it's not that simple. It's not that simple, right? But trust me, we're gonna look at some other information next week that, as I said, is gonna give us a better picture of what the company is and whether or not it would make a good investment. All right. Let me see if there are any other questions before I wrap up. All right, to answer doing questions already. All right, is there anyone who asked a question that I would have missed? All right, I think that's it. Guys, thank you so much for joining me tonight. Hopefully the session was helpful. If it was, Please leave the video a like. It really, really helps the channel grow. If you have not subscribed yet, please do so now. If you have learned something, please share the video with someone else so that they could learn as well. So next week, we're going to go into part 3. Part 3 is all qualitative. So we're not going to look at any numbers at all. We're going to talk about the company from a qualitative perspective. And we're going to see how some pieces of information can help us understand the company better. And we're going to just discuss it further. All right. All right, guys. Thank you so much again. I will see you next week.